morning, traders. Welcome to the weekly Elliott Wave Street update. I'm Juan Maldonado, and it's a pleasure to start the week, because yesterday was holiday, with the best wave counts. So before we start, because we have a lot to talk about today, these fantastic markets, we're going to check the euro, we are going to check the Bitcoin, we're going to check the S&P and the bonds. Before we start, I want you to visit us on ElliottWaveStreet.com. Under the membership tab, you're going to find our plans. If you want to get our fantastic Elliott Wave analysis every day, we post fresh reports every morning before the New York Open, the New York Stock Exchange Open on Forex stocks or the full access. And you can take your trial for just $19 your first month. All right, so let's start here with the euro. On the weekly chart, on the bigger picture, the price has been doing a consolidation around this area. It was quite tough trading after the consolidation that started last November, last year, and finally it broke out a little bit to the upside, which is good. And now we're seeing the rejection. But the main plan, let's draw the plan for this year, is to have price coming down here to the previous low, rejecting from there, and starting a bullish move back to the previous high. 123, 124, probably we can go to 128 to 129 area. And from here, this could be the beginning of the move. But as you can see, the plan is to first of all have a leg down to test the area below the 112 or maybe the 111 area, and watch the price if it starts slowing down and if we start seeing some good demand to work with and to start following the move up. Also, we can see on the left that that area is really important because it's where the last demand point started, and that's what the market has been trying to test out. But I think we need to have the lower low. All right, so now that we understand the big picture plan, it's easier to go to lower time frames like the 4-hour chart and find out what's going on. Look, here we have this channel. The way I built the channel was by connecting the beginning of the move down here, taking care of this hit, this near hit, and this hit as well. So the plan when we are building a proper trend line is to try to have the most test possible on that demand line, right? Demand or trend line, because is where the demand went aggressive after going to those levels. But look, and then we copy and paste this line that is the upper channel line, is exactly the same line, just copy and paste, and I put it here. And look, precisely there is where the market rejected. That type of trade is difficult because when you are seeing the market going up aggressively, you are expecting maybe something different. So let's review what we can expect with these movements in terms of the theory. When we have a wave 1, when we have a wave 2, when we have a wave 3, the plan is that the big guys, they start booking their profits. So the market starts going sideways because they slowly do the distribution cycle in order to slowly take their profits. So usually it's a small retrace, it's a sideways range, and once it's done, the price makes the high in order to take out those who went short already. They book their profits, and that's the plan in the impulse. But when we have the same pattern and we are under a possible wave 3, let's say like here on the euro, and instead of seeing this consolidation, that is when the market is creating value, we have this leg coming down like this, really strong. So it's fresh selling. The institutions were closing their positions heavily, right? So a lot of things to don't try to go long, clearly, when we have this first leg down. And that is also telling that this might be the top of this corrective that we are looking. So look, the internal plan for this week is going to be real simple. I'm looking to see the completion of this 5-wave sequence, 1, 2, 3, 4, 5. And once it's done, here during the discount, during the test, because the test is when we have a movement and then the big guys want to check if there are aggressive buyers. We don't have a volume, we don't have access to volume in the forex markets. We could have some volume coming from the CME, but it's not the whole market. Or we can work with a tick volume, but it's not going to be the real volume. So the problem is that we in the forex market we can't have a real volume, because the plan is that during the test the volume should be decreasing. But because we don't have volume, we have to check momentum, right? What else? So if the price loses momentum here and we have a good setup, I'm going to sell it here this week in order to target this 112 area. The plan is to have another leg down back to this area. So today, bearish on the euro, a strong US dollar. I'm going to explain in this video why. At the end, when we go to the bonds, I'm going to explain why the dollar is likely to get stronger this week. This is the Bitcoin. The Bitcoin is absolutely interesting. Let's talk about a change of behavior. When we have the price coming down, let's say moving down, we have each retrace lower than the previous retrace. Perfect, healthy trend, no problem. But what if the market starts moving up and crossing the previous retrace? Is starting to do something different, right? It's a change of behavior. Before it was making the lows and everything, but eventually it starts to change of behavior. When this event happened, you know that the trend, the blue trend, is done. Could be that the market needs to consolidate and continue lower, or could be that the market needs to start doing a different trend, right? So this is just telling that the previous trend finished. It's not telling the direction. We are going to solve that out with the wave count. So let's have a look in real life how we can apply this concept. Let's see an example that already happened. For example, look at this one. Great, right? But eventually we have this change of behavior. And that's telling that this is it. And if you have a contest with the wave count, we started to sell here the Bitcoin. So if you have a contest, that's a fantastic validation, right? So now let's do it in the live market, because it's happening again. So we are seeing the cycles, 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 everything goes well, and eventually, price starts changing the behavior, telling that the previous trend is done. Now we add context that we were finding a B wave on the Elliott wave theory, and we add more Elliott wave theory, 1, 2, 3, 4, 5, right? And then we have the price moving down, losing momentum. In the crypto world, we can't have a volume similar to Forex. And look, we are seeing the price losing momentum. What's the next step? Well, will be good to see some demand triggering here. Imagine a green bar triggering the market here, closing above this area, showing demand. We don't want to see big red bars, right? We don't want to see a follow-up here. That would be something different. But if we have the price reversing and showing demand, that's the entry point right there. That's it. And from there, we can have a huge move up. After that green candle, we can have a move back here to the 52s, at least, maybe higher, or to this consolidation, 47s. You know, a good trade, a good movement from here. So that could be interesting. We are watching closely the price action on the Bitcoin in order to find the proper validation. Let's have a look at the S&P. The S&P today is selling off strongly. As you may already know, Goldman Sachs shows disappointing earnings, good earnings, but not as expected, telling that their trading during the last quarter, last year, wasn't as good as expected. So that creates a sell-off. So the S&P would be fantastic. Now that we are so close to the low, I think it's going to take out the low. You know, we're so close. So we might need to have here the price cleaning up this area. And if that's the case, and we have a rejection, that's gonna be the buy trade. That's gonna be my first accumulation entry for the year. That would be fantastic. On the other hand, if they fail to push the price lower, and they start building a 5-wave sequence, we will need to go long after the 3-wave sequence somewhere here, because it will be too risky to act at this bottom of the market when we are so close to the liquidity area. And let's go to the bond market. The bond market has been going down. As you know, when the bonds are going down, the yield is going up. So our plan is to have at least one more leg down here in order to complete the bond, right? In order to complete the wave count. But look, let's make an analysis using the yields and the curve. Let me hide some of the lines that I have here so we can start with something cleaner. There we go. This is the 10-year blue line. 10-year yield, as you can see, is flying today, and the 2-year is going faster than the 10-year. So the orange line is the 2-year, and the blue line is the 10-year. So it's good to see, of course, medium interest rates higher than the 2-year short term, but look that the 2-year is moving up faster than the 10-year, right? We're going to check the curve in a second, but during the pandemic, we were seeing the bonds, especially the 2-year, calm right there. But when the inflation started to pick up, we start seeing the shorter term bond going up, and of course the 10-year bond as well. So that's telling that the market is trying to slow down things because the Fed is not acting. The Fed, the interest rate from the Fed right now is at 0 and 0.25. So banks can borrow from the Fed at 0, and they can put the money in the market at 1 at 2 years or 1/8 at 10 years, depending on each profile, each customer profile. But this is a base for lending money. So that means that they are making a lot of money, and this is causing inflation to go higher. We're having the highest inflation in 40 years, in 39 years. Since the 80s, we haven't had inflation so high. So that's an issue. And the Fed needs to go out to the market, to come here to the market and say, hey, I'm going to increase my rate. Maybe not 25 basis points. We need, the market is screaming, hey, Fed, help us. Maybe 75 basis points on the first increase this year. They have been saying, we're going to, but they haven't do anything yet. So look, the thing is that once the Fed starts hitting inflation, we are going to start seeing the bonds decreasing. And I'm going to explain in a second how this is going to impact the US dollar and the S&P. So if inflation continues higher, the yields are going to continue higher. If the Fed successfully starts pushing inflation lower, the yields are going to start at least slowing down, or maybe going a little bit lower, right? Especially the 2-year that is really aggressive. So now let's connect the yields with the US dollar. So higher yields, it depends. We need to compare with other country, right? But for example, right now the USD in the USA is offering a 1.8 rate. And Germany, if we want to compare with Europe, that is the biggest economy, is at negative 0.03. So if you buy bonds there, you're going to lose money because it's negative. So which one you pick as a fund manager? Of course, the US bond. So money flow to the United States. What is going to happen with the dollar? Should increase because demand should be increasing, right? Higher yields, better for the US dollar. Now, let's talk about the S&P. The S&P, higher yields, higher cost of money. The S&P should grow, but it should slow down. So this year, with higher rates, the S&P is going to continue higher, but at a slower pace. All right? Now, let's add the US dollar to this chart. Or no, first of all, let's add the curve. The bond curve is something simple. It's just by taking the 10-year and subtracting the 2-year, right? So if the 10-year right now is at the 1.8 and the 2-year is at 1, so the difference is 0.82. Right? So actually the bond curve, what measures is the distance between the 10-year and the 2-year, right? So when the curve is going up, it means that we are having a bigger difference. When the curve starts moving down, it starts showing that the difference is getting smaller. You can see that here, right? So we're seeing the curve going down because the spread between the two yields is getting smaller, right? And that has been the thing that has been happening. So we have been seeing the yield going down, the curve going down, and that's not good for the economy under this scenario because the Fed is not acting, right? So that's an issue. Now, let's add the US dollar. Of course, in the membership, we are covering deeply these topics every day. We're updating these fundamental every day in the daily videos. So look, the US dollar last week started to move lower, but the yield was going up. So that's creating an opportunity because, of course, this is a discount in the US dollar. Look where the yield is. Doesn't have any sense. So we were seeing this discount, and that's why I believe the euro dollar should go lower because we need to have a stronger US dollar here in order to move back to this area to create a higher high. And if at that time the Fed comes out and says, okay, guys, I'm going to make a big increase, I'm going to attack inflation, and that works, the yield should start to slow down and maybe go lower because it needs to catch up to get closer to the Fed rate that is near zero, and that could cause the dollar to drop. But with higher yields every day, it's going to be difficult for the dollar to turn around really, so the euro is likely to continue lower until we have the yields slowing down. All right, traders, so if you want to learn every day new things, if you want to get our daily Elliott wave analysis, you can have your trial. You can sign up right now for just $19 your first month, and you will get a lot of value, a lot of new content every day, live market analysis, and a deep understanding of these market cycles. Thank you very much for your time. Please have a fantastic trading session, trading week. I'll see you soon. Take care. Bye-bye.